Everyone thinks wealth is a reward for intelligence, for hard work, for discipline. That belief is comforting because it makes the game feel fair. But it is also the first illusion you must break. Because if wealth were truly a reward, the system would not consistently produce the same outcome across generations, the same families, the same structures, the same invisible patterns repeating with mechanical precision. This is not coincidence. This is architecture. And once you see it, you cannot unsee it. The rich are not just earning more. They are operating inside a completely different system of physics, not metaphorically, structurally. Imagine two objects moving through space. One is pushing against gravity every second, burning energy just to stay in motion. The other has already escaped orbit. It is no longer fighting gravity. It is accelerating in open space where resistance is almost zero. Both are moving, but only one is compounding. This is the hidden divide. Most people are trapped in economic gravity, trading time for survival, making decisions under pressure, constantly resetting their progress back to zero. The wealthy, on the other hand, operate in low-friction environments where capital, not effort, does the work. And here is where the discomfort begins. Because deep down, you already feel this. You feel it when your income increases, but your stress increases with it. You feel it when one unexpected expense collapses months of progress. You feel it when you realize that no matter how hard you push, the finish line keeps moving. That silent anxiety? That is not personal failure. That is system feedback. This is where the structure reveals itself. The system is not designed to reward effort equally. It is designed to amplify positioning. And positioning is invisible to those who were never shown the map. This is why two people can work equally hard and live in entirely different financial realities. This is why the rich keep getting richer without appearing to exert more effort. This is why most people never escape, because they are solving the wrong problem. They are trying to optimize effort inside a system that rewards ownership. They are trying to run faster, on a treadmill that accelerates with them. And the more they run, the more they believe the problem is speed. It is not. It is direction. But direction requires awareness. And awareness requires confronting something uncomfortable. The game you were taught to play is not the game that creates wealth. This changes everything. Because once you understand the true mechanics, once you see how capital moves, how systems reinforce themselves, how advantages compound quietly over time, you stop asking, "How do I work harder?" And you start asking a far more dangerous question. What system am I actually inside? That question is the beginning of escape. But it also opens a deeper realization, one that most people avoid for an entire lifetime. Because if the system is real, if the architecture is deliberate, then the next question becomes unavoidable. Who benefits from you not seeing it? The system was never invisible. It was simply never explained in a way that made it visible. From the outside, yes, it looks like chaos. Millions of people earning, spending, saving, struggling, advancing. A constant motion of financial activity that appears random, almost organic. But underneath that surface is a rigid structure, a framework that governs outcomes with quiet precision. This is the invisible financial architecture. And once you understand it, something unexpected happens. The shame disappears. Because the system was never neutral. It was directional. Most people are taught to interact with money at the level of transactions. Earn income. Pay expenses. Save what remains. Repeat. This is the survival loop. It is linear. It resets constantly. and most importantly, it does not scale. You earn, you spend, you stabilize, and then you start again. But the wealthy are not operating at the transaction level, yet they are operating at the structural level. They do not ask, "How do I earn more this month?" They ask, "What structure produces income regardless of my time?" This is the first cognitive shift, because income is not the core variable. Ownership is. This is the trap. When you're focused on income, you're locked into effort-based growth. Your progress is tied to your output. Your ceiling is defined by your time, your energy, your capacity. But when you shift to ownership, something changes. You detach income from effort. You begin to participate in systems that produce value continuously, whether you're active or not. And this is where the structure reveals itself more clearly. There are only two primary positions in any economic system: those who exchange time, and those who own the system that time flows through. Employees, freelancers, even high-income professionals, they are all operating inside systems they do not control. Their income is a function of participation. Owners, investors, equity holders, they control the system itself. Their income is a function of leverage. This distinction is everything, because systems scale, effort does not. And here is the uncomfortable truth most people never confront. You can become extremely skilled and still remain structurally disadvantaged. This is why intelligence alone does not guarantee wealth. This is why effort alone does not guarantee escape. Because neither intelligence nor effort changes your position inside the system. Only ownership does. And ownership is not just about assets like businesses or real estate. It is about control over value flows. Who captures the profit? Who benefits from growth? Who earns when the system expands? These are structural questions, and most people are never trained to ask them. Instead, they are trained to optimize within the system they are given. Work harder, improve skills, increase income, be responsible, all of which are useful, but none of which alter the architecture. This is where most people get stuck. They experience progress, but not transformation. They move forward, but never escape, because they are climbing vertically inside a horizontal system, and the system has ceilings, subtle ones, invisible ones, but absolute. This is why financial frustration often feels confusing. You're doing the right things. You're improving. You are advancing. And yet, something still feels constrained. That feeling is accurate, because the constraint is structural, not personal. And once you see that, something shifts internally. The narrative changes from, "What am I doing wrong?" to, "What structure am I operating inside?" That question is dangerous, because it breaks compliance. It disrupts the default path. It forces you to step outside the system and observe it. And observation leads to pattern recognition. Patterns like this. Why do asset owners benefit during economic expansion, while wage earners struggle to keep up? Why does inflation quietly transfer purchasing power away from savers and toward those who hold appreciating assets? Why do financial crises often create opportunities for those with capital, while destroying stability for those without it? These are not random outcomes. They are structural consequences, and they repeat over and over again. This is the architecture of wealth concentration, not conspiracy, not luck, structure. But here is where the tension deepens, because even when people begin to see this, even when they intellectually understand the system, most still do not escape. Why? Because understanding the structure is only the first layer. The second layer is far more subtle, far more dangerous, and far more personal, because the system is not just external, it is internalized. Your behaviors, your decisions, your financial instincts, they are shaped by the environment you were trained in. And that environment was not designed for ownership thinking. It was designed for participation. This is where the structure moves inside you. This is why people who suddenly earn more money often remain in the same financial position. What? Because they upgraded income without upgrading the internal model. And the internal model always wins. This is where the real trap begins. Because now, the system is no longer something you can simply step out of. It is something you carry with you. And unless you confront it directly, you will recreate the same patterns at higher income levels with larger numbers, but identical outcomes. This is why the rich keep getting richer. Not just because of what they own, but because of how they think. And that thinking is not accidental. It is conditioned, reinforced, and strategically aligned with the structure itself, which leads to the next layer of the system, the one that operates beneath logic, beneath awareness, the one that quietly controls behavior, even when you believe you are making rational decisions. This is where most people lose the game, without ever realizing they were playing one. And once you see it, you will understand why escaping the system is not just about strategy. It is about rewiring something far deeper. The system does not fail you through logic. It controls you through behavior. This is where the structure becomes more precise and far more dangerous. Because even when people understand that ownership matters, that systems scale, that income alone is not enough, they still behave in ways that keep them anchored to the same financial reality. Not because they lack intelligence, but because their decisions are being driven by forces they do not consciously recognize. This is behavioral finance at its core, and this is where the trap tightens. Every financial decision you make is not purely rational. It is emotional, conditioned, reactive, and the system knows this. In fact, it depends on it. This is the hidden layer most people never examine. Why do people upgrade their lifestyle the moment their income increases? Why does a raise feel like permission to spend rather than an opportunity to invest? Why do short-term pleasures consistently override long-term positioning? These are not random tendencies. They are predictable patterns, and predictable patterns can be engineered against you. This is where consumption becomes a control mechanism. Because when your behavior is tied to immediate gratification, your financial trajectory becomes fragmented. Every impulsive decision interrupts compounding. Every emotional purchase resets progress. And slowly, invisibly, you remain in motion, without ever gaining momentum. This is the trap. The system rewards patience, but conditions urgency. It rewards delayed gratification, but sells instant reward. And most people never realize they are being trained to choose against their own long-term advantage. Consider this: a person receives an increase in income. Logically, this should accelerate wealth accumulation, but behaviorally, something else happens. Their environment shifts. Their social circle adjusts expectations. Their identity begins to expand toward consumption. Better phone, better clothes, better experiences. Subtle upgrades that feel justified, even deserved. And here is the critical detail. None of these decisions feel irrational in isolation. That is what makes them powerful. Because the system does not rely on one catastrophic mistake. It relies on thousands of small, reasonable decisions that collectively destroy compounding. This is lifestyle inflation, and it is one of the most effective wealth suppression mechanisms ever created. Not enforced, self-inflicted, but influenced. This is where identity enters the equation. Because people do not spend money based on logic. They spend based on who they believe they are, or who they are trying to become. This is where the structure reveals itself again. If your identity is tied to visible success, you will prioritize signals over substance. You will invest in appearances over assets. You will chase validation instead of positioning. And the system will reward you, socially, while quietly extracting your financial future. This is the illusion of status, the car that signals success, but depreciates. The lifestyle that signals freedom, but requires constant income to sustain. The image that signals wealth, but hides fragility. This is not accidental. It is engineered. Because visible wealth is easier to sell than invisible ownership. And the more you chase visibility, the less you invest in structure. This is why many high-income individuals remain financially vulnerable. Because income amplifies behavior, it does not correct it. If your default pattern is consumption, more income simply accelerates the cycle. Faster earning, faster spending, same destination. This is where most people misinterpret financial success. They assume that higher income equals progress, but income without behavioral alignment is just fuel. And fuel without direction only burns faster. This is where the system becomes self-reinforcing. Because now, your environment begins to mirror your behavior. You surround yourself with people who normalize spending. You absorb expectations that reinforce consumption. You calibrate your standards based on visible lifestyles, not structural wealth. And slowly, your perception of normal shifts. This is the invisible drift. And once it happens, returning to disciplined behavior feels like regression, even when it is advancement. This is why most people never correct course. Because the correction feels like loss, and humans are wired to avoid loss more than they pursue gain. This is loss aversion, one of the most powerful behavioral biases in finance, and it is constantly working against you. You hesitate to invest because of potential loss, but you spend freely because the loss is not immediately visible. You avoid short-term discomfort at the cost of long-term positioning, and the system quietly benefits from that trade. This is where emotional triggers take control. Stress leads to spending. Boredom leads to consumption. Insecurity leads to status signaling. Each emotion becomes a financial action, and each action reinforces the same cycle. This is not weakness, it is conditioning, and conditioning can only be broken when it is seen clearly. But here is the deeper layer. Even when you recognize these patterns, even when you attempt to change them, you will feel resistance. Not external resistance, internal. Because your current behavior is not just a habit, it is an identity. And identities defend themselves. This is why financial change feels uncomfortable, why saving feels restrictive, why investing feels risky, why delaying gratification feels unnatural. Because you are not just changing actions, you're challenging who you believe you are. And unless that identity evolves, the system remains intact, inside you. This is why the rich keep getting richer, not just because they have more capital, but because their behavior aligns with compounding. Their spending is strategic, their consumption is controlled, their identity is detached from visible status and anchored in invisible growth. They do not play the same behavioral game, and that changes everything. But behavior alone is not the full story, because even if you master your decisions, even if you eliminate emotional spending, there is still a deeper force at play, a mathematical force, cold, unemotional, unforgiving, the force that determines how fast wealth actually grows or doesn't. And most people underestimate it completely because they are thinking in effort, while the system operates in exponential curves. This is where the gap widens permanently. And once you see the numbers, you will understand why time, not effort, is the real battlefield. Wealth is a numbers game, not in the superficial sense of make more, save more, spend less. That is linear thinking. That is the treadmill. That is what keeps 90% of people trapped in motion without momentum. The real game operates in compounding, thresholds, and velocity. And this is where the mathematics of wealth becomes almost unfair to the uninitiated. Let's begin with a simple principle: exponential growth. Money grows not by adding, it grows by multiplying. Yet most people think in addition. I earned $50,000 last year. If I earn $55,000 next year, I'm winning. But in the compounding world, the real question is, what assets do you own that generate more than what your labor alone can produce? This is not incremental, it is geometric. Small differences in rate of return or timing create massive divergences over years. Consider this: two individuals start with $10,000. One invests with a conservative 7% annual return. The other does nothing. After 30 years, the investor has approximately $76,000. The non-investor? Still $10,000. That's the same money, but in one case it was positioned to compound. One step created a geometric divide, and it accelerates. Now introduce thresholds. Wealth is not continuous, it is tiered. Yes, there are natural inflection points in capital where dynamics shift dramatically. For example, at $100,000 of invested capital, you can access investment opportunities unavailable to someone with $10,000. Private deals, preferred shares, lower fees, leverage instruments, all invisible to outsiders. Once you pass certain thresholds, the system begins to work for you in ways that would appear impossible to those still below it. And this is why the rich don't just accumulate linearly. They experience wealth inflection. Velocity is the next layer. Money in motion is more powerful than money at rest. Two people may have $1 million each. One keeps it in a single static investment. The other distributes it across assets that turn over, reallocate, and capture emerging opportunities. Even a slightly higher turnover rate exponentially increases outcomes. Wealth accelerates through velocity, while stagnation produces only nominal growth. This is why holding capital is not enough. It must flow strategically, like a river eroding rock to create valleys of advantage over decades. Let's bring this down to numeric modeling. Imagine three friends: Alex, Blake, and Casey. Each starts with $50,000 at age 25. Alex invests passively at 7%, reinvesting all returns. Blake invests actively, finding small, high-risk, high-reward opportunities, achieving 12% annually. Casey saves diligently, but never invests, letting the money sit idle. By age 50, Alex has roughly $275,000. Blake, using compounding and velocity, has over $500,000. Casey? Still $50,000. Notice the difference. Same starting capital, different strategies, same time frame, but different outcomes, an order of magnitude apart. And here is where psychology intersects with math. Most people underestimate time and overestimate effort. They believe wealth is created by doing more work, more deals, more hours. But in reality, wealth is created by structuring capital to operate independently. Your labor buys you leverage. Your leverage buys you velocity. Your velocity amplifies thresholds. Your thresholds unlock compounding. This is the secret arithmetic of the rich. But compounding alone is not enough. Timing is everything. Strategic entry and exit points multiply gains or prevent catastrophic losses. $1 million investment in a booming sector 1 year earlier than competitors can yield returns that seem like luck but are actually structural advantage. Conversely, the same million invested a year too late or withdrawn too early can produce nothing. Wealth, therefore, is not just capital, it is strategic timing applied consistently. The ultimate principle is this: the rich do not merely earn money, they create ecosystems of capital. Each asset feeds the next. Each investment is a node in a network. One property generates cash flow that funds a business that acquires equity, that accesses private deals, that compounds exponentially. Every layer feeds upward, creating an accelerating spiral. And this is why, mathematically, it is nearly impossible to compete linearly against exponential growth. Most people never see this because they think in months, weeks, even days. They measure success in effort applied, income earned, promotions gained. The rich measure in decades, in systemic velocity, use in threshold leverage. Their horizon is long enough to allow compounding to dominate. Your neighbor's lifestyle, your peer's income, your own short-term wins, these are irrelevant variables. Time, strategy, and structure are everything. And here is the final, often overlooked component: asymmetry. Not all risks are equal. High-return opportunities often carry asymmetric risk. Small downside, massive upside. The wealthy design their portfolios to exploit these asymmetries. Ordinary investors, trained to fear loss, avoid them. And this is the hidden mechanism behind wealth divergence, the ability to position for asymmetric gains without being consumed by fear. This is where numbers meet identity, behavior, and structure. Without aligning all three, the compounding spiral never initiates. Effort without positioning, a discipline without ownership, or patience without strategy, none of it scales. And this is why intelligent, hard-working people can still fail. Which leads directly to the next layer: social programming, lifestyle inflation, and environmental pressure. Because even when the math is understood, external and internal forces conspire to erode advantage. And this is where most people lose momentum without ever realizing it. Intelligence is not immunity. Hard work is not protection. You can have an IQ in the top percentile, graduate at the top of your class, and still fail financially. The reason is not a lack of effort or smarts. It is social programming, lifestyle inflation, and environmental pressure quietly shaping your decisions. The system operates as much through psychology as mathematics. And this is where most people unknowingly sabotage themselves. Consider lifestyle inflation. Every incremental increase in income often triggers an equivalent increase in expenditure. A promotion at work, new car, better apartment, trendier wardrobe. Suddenly, the raise that was supposed to accelerate wealth becomes a trap. The richer you appear externally, the more obligations accumulate internally. This is why so many successful professionals remain one crisis away from financial collapse. The system does not reward appearances. It rewards underlying capital structure. Appearances are costly illusions. Decision fatigue compounds this problem. Intelligent people analyze, optimize, and deliberate constantly. They make careful choices, but every choice depletes cognitive resources. By the time they encounter critical financial decisions, their mental bandwidth is exhausted. They revert to defaults: comfort over strategy, consumption over investment, visible status over invisible growth. This is not laziness, it is biology. Every brain has finite resources, and without deliberate structuring, the system ensures that instinctive decisions favor short-term gratification. Environmental pressure amplifies this effect. Humans are social animals. Social circles, family expectations, cultural norms, all exert subtle, constant influence. If your peers measure success by lifestyle signals, your behavior will shift to conform. Spending becomes a performance. Investment becomes a debate. Ownership mindset is crowded out by social consensus. Even intelligent people are subject to this invisible force, often believing their choices are autonomous when they are deeply socially conditioned. Even awareness does not guarantee escape. Many understand the traps intellectually, but fail emotionally. They know that lifestyle inflation, decision fatigue, and social pressure exist, but the discomfort of resisting is immediate, tangible, and powerful. Delayed rewards are abstract. Immediate validation is visceral. Human psychology is wired for instant feedback, and the system exploits this relentlessly. And here is the cruel irony. Those who are most capable are often most vulnerable. Smart, high-achieving individuals tend to believe in meritocracy. They trust effort, and intelligence will yield proportional outcomes. They assume rationality governs the world. But the financial system rewards structural advantage, compounding, timing, and behavioral alignment, not effort alone. This is the misalignment between capability and outcome, and it creates a quiet, persistent sense of frustration. Now consider social signaling again. The urge to display success is primal. Human beings are wired to seek status. But in the financial system, status is often a masquerade for fragility. A new car, a bigger house, exotic vacations. These are signals that appear like wealth, but are funded by income that does not scale. And every signal costs capital that could otherwise be leveraged into compounding. The system does not punish visibility. It simply redirects your resources away from structural accumulation. This is why many high-income earners never build lasting wealth. They are performing wealth rather than capturing it. Decision fatigue, lifestyle inflation, unsocial pressure, they create an invisible ceiling. No matter how intelligent or skilled you are, these forces gradually erode advantage. And here is the hidden mechanic. They are cumulative. Every choice reinforces defaults. Every social signal resets priorities. Every rationalization strengthens old patterns. Over years, these invisible forces quietly undo compounding, effort, and skill. Even environment plays a role. The neighborhoods you inhabit, the networks you join, even the media you consume, all subtly calibrate expectations. Exposure to scarcity thinking reinforces risk aversion. Exposure to consumer culture reinforces spending. Exposure to peers focused on income over ownership reinforces the treadmill. Smart people unconsciously absorb these signals, believing they are making autonomous decisions. But autonomy is largely an illusion without deliberate structural alignment. And so we arrive at a paradox. The very intelligence that allows someone to navigate complexity also makes them vulnerable to subtle manipulations. The very effort that should accelerate progress becomes a liability when unaligned with the system. The very social instincts that create connection also enforce invisible constraints. This is why the rich keep getting richer, even when smart, hardworking people are around them. Because structural advantage, behavioral alignment, and environment combine to amplify outcomes in ways that pure intelligence cannot counteract. This is where most people stall. They understand the math. They see the behavior. yet they remain trapped by external pressures and internalized conditioning. And yet, the system itself has one last secret. It is brutally numerical. And when aligned properly, it produces velocity that overrides all environmental friction. This is the point where mathematics, behavior, and strategy converge. Where compounding ignites, thresholds break, and exponential growth begins to dominate. Next, we will unpack this final layer, the strategic wealth blueprint. How capital, skills, and risk can be stacked intentionally to escape the traps that consume so many intelligent, hardworking people. The moment most people attempt to build wealth, they make a fundamental mistake. They treat money as a static resource instead of a strategic tool. They see dollars as numbers in a ledger, not as levers in a dynamic system. The strategic wealth blueprint is designed to change that. It is a systematic architecture for turning capital, skill, and timing into compounding velocity that grows exponentially over years. And it begins with one principle: structure before scale. Step 1 is capital allocation. Most people invest haphazardly. Retirement accounts, savings accounts, occasional stock purchases, or whatever seems trendy. The wealthy allocate deliberately. They divide capital into clearly defined layers: cash for liquidity, conservative assets for stability, growth assets for compounding, and high-risk asymmetric opportunities for optionality. Each layer has a specific function and a role in risk mitigation. It is not just diversification, it is intentional design, like constructing a building where every support beam has a precise engineering purpose. Next comes asset acquisition logic. Wealth is not built by owning singular assets. It is built by owning systems that generate value. Real estate? Acquire properties that produce net positive cash flow and appreciate over time. Business? Acquire or create systems where revenue scales independent of your time. Stocks? Focus on ownership in companies with compounding internal growth engines and structural advantages. The underlying principle is control over value creation. You do not chase assets randomly. You acquire nodes in networks that will feed each other, creating an interconnected ecosystem of growth. Risk mitigation is the third layer. Many aspiring investors focus solely on returns, ignoring structural risk. Wealth is fragile when it is concentrated or unprotected. The blueprint emphasizes asymmetry. Protect the downside, maximize the upside. This is accomplished through hedging, diversification across uncorrelated assets, insurance structures, and legal protections. The wealthy engineer resilience into the system itself so that crises amplify opportunity instead of creating collapse. Risk is not avoided. It is systematically managed. Skill stacking is equally critical. Money alone is insufficient. Knowledge multiplies its impact. The wealthy combine financial intelligence with operational expertise, negotiation skill, and strategic networking. Each skill amplifies the effectiveness of capital. For example, knowing how to analyze market cycles, structure deals, and leverage tax strategies increases return efficiency and reduces friction. Skill stacking transforms capital into a multidimensional force capable of exploiting opportunities others cannot see. Cash flow architecture is the next layer. Ownership without cash flow is theoretical. Wealth must produce liquidity to feed optionality. This means structuring assets to generate recurring revenue streams while maintaining reinvestment discipline. The wealthy prioritize cash-generating assets because they fund further accumulation, enable strategic flexibility, and allow compounding to function without interruption. Cash flow is not consumption. It is fuel for acceleration. Long-term asymmetry thinking is the final principle. Most people evaluate decisions in isolation, focusing on immediate outcomes. The wealthy think in decades, not months. Every investment, every partnership, every financial move is assessed for potential asymmetry, the ratio of upside to downside over a long horizon. This mindset transforms uncertainty into opportunity because it identifies situations where systemic advantage exists. One asymmetric position can dominate decades of incremental effort, turning ordinary actions into extraordinary results. The strategic wealth blueprint is not theoretical. It is a framework that converts insight into repeatable action. Capital without structure is chaos. Skill without deployment is wasted potential. Cash flow without reinvestment is inertia. By combining allocation, acquisition logic, risk mitigation, skill stacking, cash flow, and asymmetry thinking, the wealthy engineer an ecosystem of wealth that operates independently of short-term effort. And here is the critical point most people miss. Each layer compounds the others. Cash flow fuels new asset acquisition. The skill multiplies the efficiency of capital deployment. Risk mitigation protects growth from disruption. Asymmetry positions amplify velocity. This creates an invisible feedback loop where growth accelerates automatically, silently, and relentlessly. The system becomes self-reinforcing. This is why linear effort, even when intelligent and disciplined, can never match strategic compounding. Ordinary wealth accumulation is additive. The strategic wealth blueprint is multiplicative. Effort alone cannot escape the treadmill. Structure alone cannot exploit opportunity. Alignment of both, sustained over decades, produces the exponential curves that separate the rich from everyone else. And the final layer of the blueprint, the engine that transforms strategy into unstoppable momentum, is the acceleration phase. Here, so the system is no longer merely structured. It is optimized for timing, leverage, and optionality. This is where calculated positioning allows wealth to outrun friction, outpace inflation, and scale beyond what effort or skill alone could achieve. The blueprint provides structure. The assets provide compounding. The skills provide leverage. But structure alone is static. Without acceleration, even the most well-engineered system moves at human pace. The acceleration phase is where the system shifts from controlled growth to exponential velocity. It is the engine that transforms planning into unstoppable momentum. Acceleration is powered by a dual-engine system, income plus assets. Most people focus exclusively on income, their work, their salary, their professional output. But income alone is limited. Hours are finite, while energy is limited. To truly accelerate, the wealthy combine consistent, scalable income streams with assets that grow independently. Income fuels opportunity. Assets amplify returns. Together, they create a feedback loop. More capital flows into strategic positions, which generate more cash flow, which enables higher value acquisition, which compounds faster. This is not theory. It is structural physics applied to finance. Optionality is the next layer. The rich do not commit blindly. They cultivate multiple pathways for opportunity, hedges against uncertainty, and potential positions that can become massive under the right conditions. Options are not just financial instruments. They are strategic levers. Owning the ability to pivot, the ability to enter markets ahead of competitors, or the right to acquire undervalued assets creates a system where potential asymmetry dominates risk. Optionality multiplies growth velocity without requiring linear effort. Leverage is both a tool and a weapon. But here lies the distinction: leverage controlled versus leverage abused. Ordinary investors borrow indiscriminately, amplifying risk without increasing structural advantage. The wealthy deploy leverage precisely. Debt is used to acquire assets that produce more than the cost of capital, creating positive arbitrage. This is how capital multiplies itself. The key is discipline. Leverage must never be a shortcut. It must be a calculated amplifier inside a system designed to absorb shocks. Misapplied leverage destroys compounding. Correctly applied leverage accelerates it. So strategic timing windows are the invisible corridors where acceleration becomes possible. Markets, industries, and economies do not move uniformly. Opportunities appear briefly and then vanish. The wealthy recognize patterns and position themselves in advance before consensus catches up. One well-timed move can outperform years of ordinary investment. Timing is not luck. It is a learned pattern, a structural awareness of cycles, thresholds, and asymmetries. This is why they can take decisive action when others hesitate, turning uncertainty into velocity. Acceleration is not just about acquiring more. It is about amplifying every component of the system simultaneously: assets, cash flow, skills, leverage, and optionality. Each layer compounds the others. Every feedback loop is designed to produce faster, more resilient growth. While most people operate linearly, reacting to circumstances, the wealthy engineer a system that anticipates, reacts, and adapts automatically. At this stage, decisions are no longer daily struggles. They are strategic maneuvers executed with precision. Risk is not avoided. It is anticipated. Opportunity is not chased. It is structured. Cash flow is not consumed. It is redeployed. Every move produces velocity while protecting against disruption. Yet acceleration is not merely external. It requires an internal shift, the ability to detach from short-term noise, resist impulses, and think in decades rather than months. Without this internal control, even the most optimized system can be sabotaged by emotion. This is where psychology and strategy converge. The wealthy do not merely build external systems, they evolve internally to match the demands of acceleration. The acceleration phase is where wealth begins to move faster than the environment around it. Inflation, market fluctuations, social pressures, all these forces become background noise instead of obstacles. The system now operates autonomously, compounding silently, relentlessly, invisibly. And those who do not understand the mechanics, those still operating on effort, linear thinking, or emotional reactions, cannot catch up. This is why acceleration separates the rich from everyone else. The strategic wealth blueprint provides structure, but the acceleration phase converts structure into unstoppable momentum. It is the stage where compounding is no longer a principle. It is a machine. And once this machine is in motion, it carries the operator far beyond the reach of ordinary financial constraints. But acceleration alone is not enough. To fully harness it, the operator, the individual, must evolve. Not just in skill, but in identity. Because without a psychological alignment to long-term compounding, velocity will either be mismanaged or self-sabotaged. And that is where the next phase begins: identity evolution. The internal transformation that allows the system to operate unhindered, where delayed gratification is instinct, strategic detachment is natural, and thinking in decades becomes the default lens. Acceleration is meaningless without internal alignment. The system can be optimized, assets can compound, leverage can multiply. But if the operator's identity is tethered to short-term validation, emotional spending, or external approval, the machine will be sabotaged from within. Identity evolution is the stage where the operator transforms psychologically, rewiring instincts to match the scale of opportunity created by the strategic wealth blueprint and acceleration phase. At its core, identity evolution begins with delayed gratification rewiring. Most people operate on an immediate feedback loop. Pleasure now, consequence later. The wealthy internalize the opposite. They understand that compounding is not instantaneous. It is invisible, incremental, and relentless. This requires patience beyond typical human experience, a neurological adaptation to resist the lure of instant reward. The brain itself must be conditioned to prioritize unseen gains over visible consumption. Every decision is evaluated not by immediate satisfaction, but by systemic contribution to long-term positioning. Strategic detachment is the next layer. Identity must be disentangled from income, consumption, and status symbols. External validation becomes irrelevant because it is misaligned with growth objectives. Emotional attachment to assets or short-term performance must be minimized. The wealthy view capital, businesses, and investments as nodes within a network, not personal trophies. Detachment allows for rational, unhurried decision-making, preventing panic, impulse, and reactive errors from disrupting the velocity of compounding. Thinking in decades, not months, is the most subtle but most powerful shift. Ordinary decision-making is anchored in quarters and annual reviews because that is what workplaces and society measure. But wealth operates on multi-decade timeframes. An identity must expand to encompass this horizon. Every acquisition, every investment, every risk is evaluated for its 10, 20, even 30-year trajectory. Short-term fluctuations become inconsequential. Patience transforms from virtue into instinct. The horizon is no longer a point in time, it is a framework for action. This evolution also involves cognitive patterning. The wealthy internalize structural principles so deeply that behaviors become automatic. Risk assessment, compounding evaluation, optionality recognition. These processes move from conscious deliberation to instinctive response. Mistakes are less costly because cognition operates at a systemic, anticipatory level rather than reactionary, emotional levels. The decisions that would paralyze ordinary investors are executed smoothly because the internal model now mirrors the architecture of wealth itself. Identity evolution also requires emotional recalibration. Fear, anxiety, and social comparison are natural human responses, but in the evolved operator, they are repurposed as signals, not directives. Fear indicates an area for strategic mitigation. Anxiety signals potential misalignment. Social comparison becomes a diagnostic tool rather than a driver of consumption. Emotional energy is redirected to systemic insight, reinforcing the feedback loops that sustain growth. Another critical component is resilience. Even with structure, acceleration, and cognitive alignment, setbacks are inevitable. Market corrections, geopolitical shifts, and unexpected personal events challenge every operator. Identity evolution builds the psychological infrastructure to absorb shocks without losing composure or deviating from long-term strategy. Discipline becomes automatic, patience instinctive, and strategic thinking default. This is why the wealthy recover from crises faster and often capitalize on them, turning disruption into opportunity. Finally, identity evolution completes the transition from operator to architect. Ordinary individuals react to circumstances. The evolved operator designs circumstances. Every decision is proactive, every move calculated, and every horizon extended. Wealth becomes not just accumulation, but mastery over the dynamics of growth itself. Behavioral alignment, cognitive conditioning, and emotional resilience converge to produce an operator capable of sustaining velocity indefinitely. Without this evolution, even perfectly structured systems and high-velocity capital can falter. Impulses, identity misalignment, and short-term thinking will erode compounding silently over time. But with identity evolution, internal alignment matches external structure, creating a state where wealth accumulation is no longer vulnerable to psychology or social pressure. It becomes a natural extension of the operator's being. And once identity is evolved, a final layer of mastery emerges, redefining what wealth, freedom, and power actually mean. Because true wealth is not the sum of assets, it is the capacity to operate without limitation, untethered from external validation, and fully aligned with systemic advantage. This leads directly into the next stage: wealth redefinition. By now, you have seen the architecture, aligned behavior with strategy, works accelerated capital, and evolved identity. Yet most operators stop short of the final, most transformative stage: redefining wealth itself. Because if you measure wealth by income, consumption, or social status, you remain trapped in the same mental constraints that the system imposes on the uninitiated. True wealth is not a number. It is a framework, a state of being, and a capacity that extends far beyond money. First, wealth must be redefined beyond income. The common mindset equates high earnings with high net worth, yet many high earners remain cash flow fragile, debt-laden, or asset poor. The evolved operator understands that income is a means, not an end. Wealth is the compounding structure of assets under control, generating velocity and optionality independent of labor. It is not about how much money arrives in your account. It is about what that money can do autonomously, continuously, and strategically. Next, freedom must be redefined beyond consumption. Society teaches that freedom is the ability to buy, spend, and experience. But this is illusionary. True freedom is operational, the ability to make decisions without external constraints, to seize opportunity without fear, to pivot when the environment shifts. It is mobility of thought, resources, and time. The wealthy are free because their system of capital, skills, and leverage creates autonomy. They can act without the friction that constrains the majority. Consumption is secondary. Systemic freedom is primary. Power, too, must be redefined. Traditional narratives equate power with status, influence, or visibility. But these are fleeting and fragile. Real power is the capacity to shape outcomes, to structure environments, and to orchestrate opportunity across decades. The wealthy wield power through control of value flows, optionality, and leverage, often invisibly. It is silent, systemic, and exponential. This is why they can move decisively while others react, and why they thrive when environments shift. Visibility is optional. Impact is structural. Redefinition also reframes risk. Where most see danger, the evolved operator sees asymmetry. Where ordinary participants see volatility, the wealthy see optionality. Where others measure loss, they measure leverage. By reframing what truly matters, the operator transforms fear into fuel, volatility into opportunity, and uncertainty into velocity. This is how wealth transcends money. It becomes a lens for perceiving and acting in the world. Finally, wealth is redefined as a generational and systemic phenomenon. Ordinary thinking focuses on self, income today, lifestyle now, consumption patterns. The evolved mindset evaluates legacy, networks, and compounding over time. Assets are not just for immediate growth. They are nodes in a system designed to amplify over decades, affecting future generations, industries, and opportunities. The scale of thinking shifts from months to decades, from individual to systemic, from temporal to structural. This redefinition completes the transformation. Wealth is no longer a pursuit, it is an operating state. Freedom is no longer a privilege, it is a structural condition. Power is no longer performative, it is invisible and exponential. Once this perspective is internalized, all prior effort, the structure, acceleration, identity evolution, becomes a coherent system. Compounding is no longer interrupted by emotion, environment, or social pressure. It becomes the natural trajectory. Yet understanding and redefining is not the final step. Conceptual mastery must meet action. The system, once fully internalized, demands a challenge, an application of all layers, strategic execution, acceleration, and identity alignment. This is the moment of ascension, where insight becomes irreversible transformation. And this leads us to the ultimate stage, the challenge plus ascension close. Everything you have seen, the hidden architecture, behavioral patterns, compounding frameworks, acceleration systems, and identity evolution, now converges. Knowledge alone is inert. Strategy alone is theoretical. Identity alone is potential. The final stage is action. The final stage is challenge. The final stage is ascension. The question is simple, yet profound. Will you operate as a participant in the system or as an architect of it? Most people will continue to trade time for income, chase status, and react to circumstance. They will spend years incrementally improving without ever escaping. But you now have the blueprint, the velocity, and the psychological alignment to break free. The challenge is to take deliberate, strategic action. Not tomorrow, not next month, now. Visualize yourself 10 years from today, not as a dream, not as fantasy, but as a projection of disciplined, aligned action executed consistently. Your capital is structured. Your assets generate velocity. Your behavior is automated in alignment with long-term compounding. Your identity is untethered from status and consumption. You're operating from a system, not reacting to one. The life you inhabit is not a product of luck. It is the inevitable result of internalized mastery. This is your call to action. Disrupt the default. Question assumptions. Redefine wealth. Align behavior, capital, and identity. Seek asymmetry. Exploit optionality. Accelerate with precision. Every choice, every investment, every decision must be measured against the long-term system you are creating. Comfort is the enemy. Delay is the enemy. Conventional thinking is the enemy. Your future self depends on the courage to act decisively today. Remember, the system rewards structure, patience, and alignment, not raw effort or fleeting inspiration. The invisible forces that keep most people trapped are real, but they are also navigable. Once you step beyond compliance, beyond default identity, beyond reaction, you enter a space where compounding, leverage, and velocity operate on your terms. This is where transformation becomes inevitable. Here is the final, unavoidable truth. The rich keep getting richer because they understand systems, behavior, and time in a way most never will. But the system is not closed. It can be accessed, mastered, and aligned with, but only if you act, only if you commit, only if you transform not just your wealth, but your identity and perspective. The moment of decision is now. The map is laid out. The mechanics are revealed. The hidden currents of capital and behavior are visible. The question is no longer whether wealth is possible. The question is whether you will step into the system fully, strategically, and without compromise. Your future self is waiting. The system is waiting. And one simple, irreversible action will determine everything. Will you ascend, or will you remain a participant forever? Act. Align. Ascend.